Welcome to Accounting in Focus. Alright, let's finish off the journal entries that we started in part 1. So in part 1 we did the first 6 entries and now we're going to do the last 6 entries. So using the same methodology that we used before, we're going to read through each transaction. We're going to decide what is important and what we have to record. So let's do number 7. And number 7 says the company pays for gasoline and other expenses incurred on jobs, $600, and they paid for it. Okay, and we've got gasoline and other expenses incurred on jobs. So why don't we just call this, we'll call this job expenses. And then our other account, because we paid for it, would be cash. Okay, let's start with cash. My cash is decreasing because I paid cash. So that would be a $600 credit. And my job expenses, my expenses going up, which is a debit. Okay, let's look at number 8. Number 8 says the company does work for a client who promises to pay within 30 days for $4,500. Okay, so when we do work is revenue. Okay, and if you're not sure about this, if you're having trouble with the revenue transactions, I do have a video on revenue recognition that you can find on the same YouTube channel that you found this one. So we do work for a client. The client promises to pay. So we did not receive cash. What do we call a promise to pay? Well, that's called accounts receivable. Okay, so we've got revenue. So my revenue is increasing by $4,500. That's a credit. My asset, accounts receivable, is also going up $4,500. So that's my debit. Let's look at number 9. The company pays for the supplies purchased in number 5. Okay, so now whenever we have a reference to another journal entry, we need to look back at that original journal entry and see what's going on. So number 5, the company purchased supplies needed for jobs on account. Okay, so let's look at number 5. We had landscaping supplies and accounts payable. Well, we know we paid for the supplies, so that would be cash. Okay, so now let's look at this other entry. So we had supplies increasing and accounts payable increasing. Now, I'm paying for the supplies I purchased here. Did I get more supplies? No, I didn't buy more supplies. Okay. Did I do something with the payable? Well, actually I did, right? I paid off that balance. So I no longer owe that vendor $1,500. I now don't owe them anything. So my accounts payable is decreasing. Okay, so my cash is going down, right? So I'm paying off that balance, so if my cash goes down, that's a credit. And then my accounts payable balance is also going down. So that is my debit. Okay. Remember, accounts payable can go up and go down. Accounts receivable can go up and go down. And actually number 10 says the company receives the money earned in number 8. So let's look back at number 8. Number 8, we had revenue and accounts receivable. So if I received money, we know that cash is involved. So let's look back at number 8. What is the other entry? Did I earn any more money? Did I generate any more revenue? No, I did not. Do I have something with the accounts receivable? Well, it says we received the money earned in number 8, so the customer's paying off that receivable. So the customer owed me $4,500. Now they owe me 0. So I need to adjust their balance on accounts receivable to reflect that they don't owe me that money anymore. So which one's my debit? Well, my cash is going up because I received payment. So my cash is increasing by $4,500. My accounts receivable is decreasing because their balance is going from $4,500 to zero. So I'm going to credit the account to show that my accounts receivable is decreasing. Number 11, the company receives a check for $1,400, which is a 50% deposit on work to be completed next week. Okay, so we received a check, okay, which means that essentially we received money. So I know the cash is one of my accounts. Now, we saw the word work, right? And every time we've seen the word work, that's been revenue. However, it says work to be completed next week. So have we done the work yet? No, we haven't done any work. So I received cash. Well, why did I receive cash? I received cash because I promised to do work next week, which means I have some type of liability. Okay, because I got $1,400 and I haven't done anything for it yet. That liability is called unearned revenue. Which means we got paid for something we have not yet done. Okay. Which one's my debit? Well, I received cash, so my cash is going up. It's $1,400. My liability is increasing, right? I now owe this client $1,400 worth of work, so I have a new debt. Okay, so unearned revenue is my credit. All right, let's look at the last one, number 12. The company pays the owner, pays a dividend of $1,000. What's a dividend? A dividend is a payment to my owners for investing in us. So if I paid cash and I had a dividend. Okay, what type of account is a dividend? Well, actually, it is a type of equity account called a contra equity account. Okay, so a contra equity account works contrary, it contradicts what a normal equity account would do. Okay, so let's do cash first. We are paying cash, so that means my cash is going down $1,000, so I'm going to credit cash. And then I'm going to debit this contra equity account. And you notice most of my equity accounts, right, when the balance increases, it's a credit. But this is a contra equity account, so it works the opposite way. Okay, so that means that when a dividend increases, it is a debit. Okay, and I'm going to post another video which is going to show how do you put all these transactions into T accounts. So stay tuned for that.